You are listening to Mining Stock Education.
I'm pleased to say that we've outperformed the S&P on a 5 and 10-year basis. We're up approximately 420%.
Welcome back to Mining Stock Education. I am your host, Bill Powers, and the mining sector has a lot of ups and downs, not just with commodity prices, but with your emotions. And you have to bring a healthy dose of skepticism, but also optimism if you're going to decide to play in these waters. And so today, let's start out on a positive note. Matt Geiger of MJG Capital, your fund is up significantly. You're beating the S&P. How does that feel, and how did you do it for investors?
Well, firstly, it's good to be joining you again, Bill, and hope all is well on your end. As always, I enjoy the Mining Stock Education podcast. I think it's a great resource for the space. I just sent out the fund's mid-year investor letter last week. We were up 35.77% in the first half of the year, which was our best performing period going back to the second half of 2020. And I'm pleased to say that we've outperformed the S&P on a 5 and 10-year basis at this point. I don't have the 5-year numbers off the top of my head, but on a 10-year basis, we're up approximately 420%. And that's relative to roughly 260% for the S&P over the same period. And on an annualized basis, that's just below 18% for the MJG fund, where the S&P is up around 13.5%. Per annum over the past 10 years. So definitely a good strong period of performance. But I make the point in the investor letter, really that the best is yet to come. I don't think anybody would argue that the past 10 years have been a pretty exceptional period for those invested in large cap U.S. equities. As a pretty wild data point, if you look at the total combined market cap globally, U.S. equities comprise 70% of the total global market cap at the moment. That's the highest it's ever been. The closest period historically would have been in the 60s during the heyday of the Nifty 50 bubble. I think that's just going to be very difficult to sustain. Greg Jensen from Bridgewater put out a missive recently, and I think he made a very good point. Just to maintain the relative weighting within the global equities, U.S. stocks would have to see 70 cents of every marginal dollar that's invested into equities going forward. And that's just to maintain the current weighting. And I find that hard to believe. I mean, keep in mind that the U.S. only comprises just over 25% of global GDP on a nominal basis. I think it's 27% of global GDP on a nominal basis. And I'd also argue that the current administration, love them or hate them, they are taking steps to upturn the set of conditions that have existed over the past 10 to 15 years that have led to this point of U.S. equity outperformance. So my thesis is that it's going to reverse to some degree. It doesn't mean that U.S. equities have to crash, but I do think there'll be relative outperformance amongst the asset classes that have largely been left behind over the past 10 years. And as another data point for you, going back 15 years, foreigners were net long roughly $3 trillion in U.S. financial assets. Fast forward to today, the number's closer to 25 trillion. So over a 15-year period, we've seen a net inflow of over $20 trillion of foreign investment capital into the United States, into U.S. financial markets. And you only need a small percentage of that to look elsewhere, diversify elsewhere, for there literally be trillions of dollars looking at other asset classes. And I think that bodes well, certainly for commodities and hard assets, but also international equities, emerging market equities, emerging debt. So I feel that the wind may be turning here, maybe at our backs for those of us invested in resources.
Matt, a few months ago, I interviewed a gentleman from Elliott Wave. And just looking at the charts, they anticipate a rotation out of tech and into commodities, and more so away from the U.S. equities into some of the emerging markets. So that's kind of what you're saying now from a fundamental standpoint, but that's what they see in the charts. Now, are you still in San Francisco in the Bay Area? Located?
That's right. Yep, in the middle of Tech Central as we speak, which is definitely an interesting place to be in the midst of this time period, and certainly off the beaten path when it comes to natural resource investors. So we do have a small community here of very sophisticated investors with decades of experience in the space. But
so do they see this? Do they see a rotation out of tech into commodities, or they're all hyped up about AI right now? So they're kind of positivistic on that, aren't they?
Well, if you talk to your average, tech-focused employee or investor, I think they're still drinking the Kool-Aid. But I think if you talk to those with natural resource experience in the Bay Area, they're certainly anticipating a rotation. But to be fair, and I'll say this first and foremost, I've been expecting this for years. And there's been a lot of false calls. I would have said during the COVID crash that marked the peak of U.S. equities dominance relative to other asset classes, and it didn't. It certainly didn't. But I think we're now on the cusp for this trend that has really existed going back to the great financial crisis. Certainly back to the commodities peak in 2011 to finally reverse course to some degree. And again, it doesn't necessarily entail a broad crash of the U.S. markets. The argument more is that there will be relative outperformance amongst these other asset classes that have really been left in the dust over the past 10 to 15 years.
What can you share about the breakdown of your portfolio that outperformed in terms of royalty companies, producers, explorers, prospect generators? Can you share with the audience how you positioned your portfolio for this outperformance?
I'd be happy to. Yeah. And in the investor letter, which is available at MJGcapital.com, I have a pretty comprehensive breakdown of the portfolio, by metal focus, by jurisdiction and by business model. But I guess a few points to touch on. The first is that we are very heavily weighted towards copper. That is our number one weighting by metal. I think it sits at 35% of the portfolio at current, at least it did on June 30th. And it's really been elevated above 30% of our weighted portfolio going back to the spring of 2024. So clearly I'm quite constructive on copper, quite comfortable with copper exposure. But I do take pains to note, our investment philosophy is we don't want to be reliant on increases in the metal prices for our investments to work. And so for each of our 7 copper-focused investments, there are catalysts in the calendar to drive value, either through the drill bit, through permitting success, through potential M&A, where I think there is opportunity, even were the copper price to stay flat in perpetuity. So while a move higher in the copper price, and copper has obviously performed quite well this year, certainly in COMEX terms with the recent tariff drama. We're not reliant on the copper price to continue to move for these investments to do well, from my perspective. So very heavily weighted towards copper. We of course have some good precious metal exposure that's served us well over the past 6, even 12 months. I think we're at 40% of the weighted portfolio exposed to precious metals. But to be clear, that also includes PGMs and silver. So I think the exact breakdown is roughly 23% exposed to gold on a weighted basis, 11% to PGMs, 6% to silver. Obviously, PGMs have seen some excitement over the past 2 to 3 months, in particular. If you go to jurisdictions, it's worth noting that almost 80% of the portfolio is exposed to one of 3 jurisdictions. That's the United States, Canada, and Brazil. Obviously, that's pretty top heavy in terms of our weighting to these 3 specific jurisdictions. But I'm clearly comfortable with our investments, understanding that looking at things purely from just a country by country perspective is a way to go astray. There are extreme nuances, with the provinces that you're based in or the states, in the case of Brazil and the United States. And of course, there are extreme differences on a project by project basis. But obviously, I'm monitoring geopolitical events closely in each of these 3 jurisdictions because that is a very heavy weighting to the 3 of them. And then finally, perhaps the most interesting point to me at the moment is our exposure to prospect generators is higher than it's ever been within the MJG portfolio. It's at around a 36% weighting as of June 30th. And that's actually going to increase further because we're looking to participate in a new prospect generator that just announced the financing, Kincora Copper. So you'll see that percentage tick up even higher when the January 2026 letter is sent out. I'm a big fan of the prospect generator model. And to be clear, when I say prospect generators, it's a little bit of a broader category that includes traditional or pure prospect generators that don't do any drilling of their own and rely wholly on partners to fund drilling. That includes hybrid prospect generators, so those that look to bring on partners on some of their projects, but also will on occasion self-fund drill programs. And that also includes royalty generators. So when I say prospect generators, I'm including those kind of three subsets of the business model. But the model's been very out of favor for many years. And I think it's set to return to favor. It doesn't even need to become the flavor of the month by any stretch. But it's been so neglected by junior mining investors that I think even a slight improvement in sentiment is gonna bode well for those with exposure. And I would argue there are a few factors that could lead it to return a little bit more to favor. The first is just the trickle down phenomenon. As you see investors increasingly move from physical metals to the producers, to the smaller producers, and then ultimately into the exploration space. So I think we're just seeing that cycle start to play out. The second is that you're seeing the big boys get more and more incentivized to beef up their project pipelines, and I think that bodes well for new deals to be signed by prospect generators and to bring in new partners, fresh blood, for more money to be put into the ground. And then the final variable that I find interesting, a lot of these PGs, not all of them, have hidden royalty portfolios that they've accumulated over the years, or in some cases decades, just kind of hiding there in the background. And we've seen a few cases over the past few years of PGs monetize these royalty portfolios, or at least parts of them. One example would be Almadex selling its Elk Gold royalty to Star Royalties. That was a few years back, and I mean that sale covered more than half of Almadex's market capitalization at the time. They're able to bring US $10 million into the kitty with that transaction. Another example was Commander Resources. Forget if it was 2024 or late 2023, sold their hidden royalty portfolio to Taurus, an Australian private equity group that is consolidating a portfolio of royalties. In that case, I believe they got their entire market capitalization, if not more, with that single transaction. And then a third example would be Eagle Plains spinning out its Eagle Royalties business about 2.5 years back. And interestingly, that's just Eagle Royalties has just announced an RTO with Summit Royalties, which is a private royalty vehicle that has been active for a couple years. And so I think we're going to see some more excitement surrounding that name. But those are a few examples, and I think there's more examples of that to come in the coming years, and that bodes well for shareholders of companies that do have those hidden royalty portfolios in the background.
Where do new royalties come from if it's not from prospect generators? Because this market is so competitive. Even when I see one royalty company bidding up and buying another royalty company, it's almost like they're doing it just to get rid of their competitors. So hopefully they can access the next royalty. I don't follow the royalty space as closely as you do. Matt, what insights might you have here?
Well, just to your direct question, I mean, there's really three ways that one can find their hands on a royalty. One is that you can do the royalty generation business model and go out and stake ground, do some early stage work, prove up some targets, attract a larger partner to take that project forward, and then carve out a royalty for yourself, rinse and repeat. So that's one way a royalty can come to be. The second is a purchase of a third party royalty. And we'll see a lot of that. And that's generally when a prospector or an early stage group will go out and stake a project. And this could have occurred 5, 10, 20 years in the past. Time passes, that project gets more valuable, perhaps advances towards production or even into production. At that point, a royalty and streaming company can come in, approach said prospector and say, hey, you might be receiving cash from this royalty when the mine goes into production in, say, 5 years. Instead of doing that and taking the development risk, why don't you take the bird in hand right now? We'll give you a few $1 million. We'll take the royalty off your hands. So that's a second way that a royalty can find its way into a royalty and streaming company. And then the third would be the origination of a royalty. And that's generally for later stage development or even construction stage projects whereas part of a construction financing package, maybe 50% of it will be equity, 30% debt, and there's a little bit of a shortfall that the company needs to get the mine built and over the line. And they may approach a royalty company and say, "Hey, we'll give you a 2% royalty if you give us the $100 or $200 million that we need to get this mine built." So that would be kind of the three ways to think about how royalties come into existence and how they ultimately find their ways into the hands of royalty and streaming players.
And there's fewer of them, and they're more competitive now, right? Than they were 10 years ago.
Yeah, that's right. I mean, mining industry has been around for a long time. And the royalty and streaming business model is actually a very new invention in the long arc of the mining industry's history. But it's definitely becoming more and more popular avenue for investors to get exposure to mineral assets. And, I would argue that I've been arguing for 2 to 3 years that consolidation is due. I mean, to your point, especially on the precious metal front, it is highly, highly competitive. But it's been a really quiet period up until the past 90 days. Like if you're a royalty and streaming focused investor, the past 90 days are one of the most exciting periods that we've witnessed. It started with Triple Flag taking over Origin Royalties. That was a $420 million deal. That would have been in late April. That was in essence Triple Flag making a move for Origin's 1% NSR covering the expanded Silicon project, which is truly a world-class gold development asset in Nevada being pushed forward by AngloGold Ashanti. So I would argue that deal right there kind of kicked off the frenzy of activity that we've seen. Kind of the next shoe to drop, and I write quite a bit about this in the letter, is Tether, one of the world's largest cryptocurrency players, taking what is now a 52% stake in Elemental Altus Royalties, which is a long-term holding of the MJG partnership. And I will say that came entirely out of left field, I think, to pretty much everybody. So that was really exciting to see really a massive financial behemoth come into the space with non-traditional mining capital. That's created a lot of waves. I mean, we're 5 weeks after that deal, and it's still the talk of the town as far as I'm concerned.
Does it represent a bigger flow of funds? The crypto bros are becoming gold bugs. Is that what it represents, do you think, or what's going on?
We'll see. I have a lot of thoughts on this. I want to be very careful in not drawing any broad, definitive conclusions about a single deal. But I think looking back 3 years from now on this deal, it could serve as a signpost or could serve as a harbinger of when non-traditional mining capital started to cycle into the space. It's certainly relevant for Elemental Altus shareholders. And I would argue it's very likely relevant for the shareholders of similarly sized junior royalty companies. Like there are about 6 at this point, precious metal focused junior royalty companies kind of in that $200 to $600 million snack bracket that Elemental occupies. And whether it's Elemental leading the charge or otherwise, I think it would behoove the whole space to see some consolidation and see that 6 become 3 or 4 in relatively short order. Like you said, there's a lot of competition for deals and also a lot of competition for investor capital. So as an investor, from my perspective, ultimately the less players, the better. So I think we'll keep an eye out on whether there's any kind of mergers of equals in that $200 to $600 million snack bracket in the months ahead. And then of course the latest shoe to drop was the Royal Gold announcement just early last week, right as the Rick Rule Symposium in Boca Raton was firing up. Royal Gold announcing its acquisition of Sandstorm Gold Royalties at roughly a 20% premium. And then Sandstorm's sister company, Horizon Copper, at close to a 70% premium. So that's close to $4 billion in total value being shelled out by Royal Gold, primarily in shares, but there's a cash component there. So that was a mega deal and was kind of the latest of the shoes to drop. But honestly, I think there's more to come, potentially in pretty short order. Kind of 2 places to look. Altius Minerals, which has been a holding of the MJG partnership since early 2020, an investment that's treated us very well. CEO Brian Dalton there has been very clear, guiding to the market, that the company is going to come to a decision imminently here on what to do with its 1.5% royalty at the expanded Silicon project. So this is the same asset that Origin, in essence, just sold to Triple Flag. And Brian, in mid-May, on the same day, they hosted their Q1 results conference call, and then they hosted their AGM. And in both of those meetings, he said point blank, we're going to come to a decision in Q2 2025. Now, it's possible they've come to a decision and it just hasn't been publicly disclosed yet, or maybe something happened that's made them to delay the decision. But either way, they're coming to a head there pretty soon. And it is possible that they decide to keep expanded Silicon, keep their 1.5% royalty within Altius. But I would take the field in terms of the other potential routes that they could pursue. And that would include a full sale of the royalty to a larger royalty player for either cash or shares. That could entail a partial sale of the royalty for cash or shares, with maybe Altius keeping 0.5% or 0.75%. Brian's also talked about a trade as a possibility, perhaps swapping the Silicon NSR with a larger royalty player in exchange for a royalty of equal value focused on non-precious metals, because that's Altius's bread and butter and always has been. It could entail a sale of the whole company. In theory, I think this royalty is big enough and significant enough and a large enough percentage of Altius's NAV where that's a possibility. Or we could see a similar deal to what happened with Triple Flag and Origin, where a larger company comes in, buys all of Altius, but with the intention of spinning out the remainder of Altius's business, sans Silicon, into Altius 2.0. So I think all of those possibilities are on the table. I will say it works in Altius's favor. Just based off of the price that Triple Flag paid for Origin, it implies a $515 million value for Altius's 1.5% NSR. But Origin put out a really interesting document, I think, for any royalty and streaming buffs that are listening in. Look up their management information circular. I believe this came out in late May. And they really provide a play-by-play highlight reel of how that whole process came to pass and the various different bids that came in and how they ultimately settled upon the Triple Flag offer. And if you look back, they give the exact date of when Triple Flag lodged its winning bid. And, from Altius' perspective, the gold price is, $333 higher than it was on that day. So I think that bodes well for Altius if they do decide to monetize the royalty. And one more potential shoe to drop, and sorry to drone on, but I think this is worth noting as well. It was announced in a 13F filing by Elliott Management. I believe this was for Q1 2025, that they'd taken a toehold position in OR Royalties, also known as a Cisco Royalties. And that definitely caught some folks by surprise, because a direct competitor, their market caps are virtually equal. A direct competitor of OR is Triple Flag. And Triple Flag, of course, is owned 65 or 66% by Elliott Management. And so one would wonder, why would Elliott Management prop up the share price, lower the cost of capital for a direct competitor of a large royalty and streaming investment that they have? It's possible. Maybe they're trying to diversify. Maybe they want some additional royalty and streaming exposure without, further increasing their ownership of Triple Flag. I think it raises the question, what are they up to? And do they maybe want to see a Cisco Royalties or OR come together with Triple Flag? And are they pushing for that? So I think that's worth keeping an eye on. I should also note, now we're playing 4D chess here, but were Triple Flag and OR to come together, their combined market cap would almost be exactly equal to Royal Gold's market cap, at least before the Sandstorm Horizon deal. So, I have great respect for Royal Gold's management team. I'm sure the Sandstorm and Horizon tie-up made sense on its own merits. But one has to wonder if in the back of the mind, they're thinking, we don't want to have competition for our slot as kind of the third largest royalty company, with the third lowest cost of capital. So maybe we do a deal now, and, build up the buffer. So once the dust settles on the Sandstorm Horizon deal, they'll be closer to a $15 billion market cap. So even if OR and Triple Flag were to come together, that provides them with some pretty good margin of error there. So some really interesting competitive dynamics. And just continue with this thought experiment one step further. Were OR and Triple Flag to come together at some point, that would mean that we would have gone from 3 mid-tier royalty companies in kind of the $1 billion to $10 billion snack bracket to 0, with Sandstorm off the board, and then the combined OR Triple Flag entity at $10 billion plus. I think that provides an interesting opportunity for 2 or 3 of these junior royalty companies, sub $1 billion, to come together and occupy that space, which was previously quite competitive.
But
so
won't the bigger fish just eat? Won't the bigger fish just eat them again, though, Matt? I mean, the bigger are getting bigger, and then the smaller are going to have a tougher time unless they group up together, like you're saying, to try to get into that $1 to $10 billion market cap range. It just seems like the whole sector is consolidating. That is the trend, because I've asked around for Hard Rock Royalties. I know of one I was told this year that during COVID, a project with a nice historic resource, the company forgot to renew the license on it. A prospector was paying attention, went in there, got it, then sold it to a publicly listed issuer, and he got himself a royalty on it. But like, those things are not easy to come by, because I've asked. I've looked into oil royalties. I thought about buying one a few years ago when oil was a lot lower, but Hard Rock Royalties, they're hard to come by, So I really appreciate your insights. Did you want to say anything else? Because I want to go back to prospect generators, but anything else on royalty companies?
No, I think we covered a lot of ground there. And I will just to supplement your point, I'd say particularly for precious metals, I do think there's a little bit of an opportunity for mineral royalties outside of precious metals. It's interesting that really only Altius Minerals and Ecora are the two groups that really pride themselves on not focusing on precious metals. The irony for Altius is that now they have a precious metal royalty that's probably worth half of their current market cap, but that came together more by chance. That was due to their acquisition close to a decade ago of Callinan Royalties, primarily at the time for Callinan's royalty over the 777 mine up in Canada. But it came with a royalty covering Silicon, which at that point was an early stage exploration project. But as that project has bloomed, that royalty has become an increasingly important part of the Altius portfolio. But I do think there is opportunity outside of the precious metal space, and it is kind of astounding to me how much attention PMs get in the royalty space, and less so to non-precious metal royalties.
Do you think the non-precious metals royalties will get a little more love from the market, especially considering the U.S. government's push with the critical metals, copper royalties or rare earths royalties or lithium royalties? Do you expect those to get a little more love in terms of the cash flow multiple?
I do. And I should note that the copper royalties in particular have seen quite a bit of attention from the more traditional precious metal royalty players. Altius is obviously big into copper, so is Ecora. We've seen EMX royalties move heavily into copper. We've seen Elemental Altus move heavily into copper. We've seen Metallo move into copper with its acquisition of Nova Royalties a few years back. Franco has a pretty heavy copper component. So the precious metal names are very happy to include copper in their portfolio, as long as it really doesn't go above 50% of their NAV or revenue. Whether those groups will look elsewhere beyond copper, I think remains to be seen. I think the Altiuses of the world would probably prefer for that not to be the case. But that is something that is a trend to watch.
As you mentioned, you were at Rule Symposium last week, as was I. Rick Rule is a huge proponent and evangelist for the prospect generator model. So one of my critiques of the prospect generator model is that my observation after 10 years of doing this is many of them are just lifestyle companies. You may not lose a lot of money with them, but you're probably not going to make money either. So why even waste your time? So with that preface, what criteria or metrics do you apply when you're screening prospect generators, especially since you're going to increase the PGs in your portfolio?
That's right. Well, we've been doing this for about three years now. An internal prospect generator model within the MJG portfolio. And we basically look at the prospect generators that are out there across North America and Australia. And it's primarily a North American business model, so it's more popular here, but there are a few Australian names. I think the current number in the model, we're tracking 35 names as it stands. And kind of as I thought how to build this model, first thing I thought is, what are the virtues of this business model? The first is that it limits dilution quite substantially relative to your traditional expiration junior. So limited dilution is one. Two, you mentioned reduced downside. There's certainly downside potential in all of these names, but compared to your traditional single asset explorer, there is limited downside amongst the prospect generators. And then the third big, merit of the business model is you get exposure to multiple assets, multiple shots on goal, funded by other people's capital. So I thought, what are three different metrics that can distill these three virtues? The first, for dilution, it's a simple calculation of runway. How much cash does the company have in the bank? What is their working capital? What is their all-in monthly burn? How much are they spending on a cash basis monthly? And how many months will it be until they need to raise capital again? So that's one metric we look at. Second metric we look at as an approximation of downside risk. We look at what is the company's market cap and how much do they have in the bank in terms of cash and marketable securities? What is that delta? And naturally, companies can fall below their cash and marketable securities position, but as a proxy for downside risk, we assume that the company will not. And, the higher that percentage, the more of the market cap covered by cash and marketable securities, at least for the sake of the model, the lower the risk in said company. And then the third thing we look at relates to spend. And I would call this the synthetic revenue to enterprise value ratio. Basically, how much money is going into the ground, in this case in 2025, spent by partners relative to what is the company's enterprise value. And that higher the partner spend figure and the lower the enterprise value, the more attractive that ratio is from an investment perspective. Again, it's a measure of how much bang for your buck are you getting, or thought another way, for every $1 in enterprise value that you're paying as an investor, how much are you getting in partner spend within these next 12 months? So those are the three key metrics I look at. I also throw in a fourth one, which is board and management ownership percentage. I'm a very big skin in the game guy, perhaps to a fault. Just because a board and management team has a lot of skin in the game does not inoculate you entirely from misbehavior or poor decision making. But I really do think incentives are everything, and I want the key players to be behaving as owners and not as employees. And so in essence, those are the four metrics we use. Rank each of them 1 through 35 across those different metrics, and then see where it comes out in the wash. And it's a really interesting exercise. Partner budgets are usually set in the spring of a given year. So we've just done outreach to all of the different prospect generators in the model, and I've gotten feedback from how much they estimate partners are going to be putting into the ground in 2025. Of course, that number can vary, but it's a rough approximation, and it's helpful for that third metric, which is the synthetic rev to enterprise value multiple. And so that's how we go about things. I should note this is not the word of God. Like, I don't look at the model and then just buy the first 5 PGs and throw my hands up and say my work here is done. This is a point to start due diligence. And there are some prospect generators, or plenty in the top 7 names, the top 20% that we don't own. And there are other prospect generators that are not included in the top 7 names that we do own. But I do just find it a very interesting place to start diligence, and also to evaluate the relative value of the PGs that we do own within the MJG portfolio and how they stack up relative to their peers. So I really enjoy doing that exercise.
What about a fifth metric? Let me get your feedback on this that I use.
All right.
Okay. You go into the MD&A, you research as best as you can. With AI, you can do things quicker. How much management has paid themselves in cash and bonus. Then you compare that to the value that they've created over their tenure at the company. Because some of these junior executives have been there 10, 20 years. Like, I passed on a junior recently because when I went into the MD&A, he's been paying himself for 2 decades. And I just didn't think that there was enough value created and he's there 2 decades later. However, the share price took off because silver took off. So good for him, good for all the investors. But what do you think about that metric?
I think it's interesting. I mean, I have actually been putting some thought into how to spice up the board and management ownership metric, because it is a pretty plain vanilla metric. I think it tells you a lot. But of course, how a board and management team got their shares as well is another variable to think about. Were these a bunch of penny options that were granted, when the company was founded? Or alternatively, as that position been acquired by consistent open market buying, potentially at prices near or even above the current share price, or heavy participation in past raises, or alternatively, did it all come from option grants? So that's another thing to look at. To your point, as of now, I will just look at that qualitatively. As if I see a name towards the top of the model that looks interesting, I'm like, hey, maybe this is a fit within the MGG portfolio. I certainly go through the management information circular. I think that's an extremely important document for really all investors to look at before they buy any junior. And we'll consider that, but more from a qualitative perspective, I do think it'd be cool to bake that into the model, perhaps next year.
Because you're well connected now in the resource sector, do you also call, if you meet a new management team that's in charge of a PG, would you call some of the other PG CEOs that you know to ask for references? Because I know that's what Rick does, and he always teaches. If I don't know somebody, I better know somebody that knows that person. Otherwise, they're in a void.
Yeah, no question. I mean, I think it is very helpful to have networks of people that you can rely on, that have experience and similar values to you within the space. So if you're a new investor, that's one of the first things I would do. Just reach out to folks and see if you can find some trusted points of contact for you to bounce ideas off of, particularly as it comes to people. But I certainly won't hesitate to reach out to the CEOs or key members of the prospect generators we own, nor will I hesitate to reach out to folks in my network that are other investors and get their thoughts on a given team, how they've behaved previously, and go from there. So I think the reference checks are an absolutely crucial part of due diligence when you're investing within this space.
Matt, my last question for today is, how are you managing your exits out of your gold stocks and your copper stocks? Because one of the drawdowns or things that you and I have to watch out for is permabulls. Like you said, we've been expecting things for a while, but it takes longer sometimes. So how are you managing, capturing those profits, those gains you have in the portfolio?
Yeah, it's a good question. I really think it's case by case, depending on the specific investment. I mean, we have one name in the portfolio, Altius, where I anticipate holding that whole position for as long as the fund exists. So that's one kind of your quintessential compounder that's just a buy and hold. As long as MJG is around, unless there's some massive negative event, we're sticking with that. There are other names. I mean, I think it's very important to have a fair value or expected value in mind for each and every one of your positions, with the understanding that number, especially as you get earlier stage in the exploration space, is going to be very inexact. But I think the exercise is important. And so for me, as a company approaches fair or expected value, I'm happy to take profits in that name as it gets closer and closer. Because firstly, you might be off with your number. Maybe you're a little bit too high or too aggressive with that number. And then secondly, from a relative perspective, compared to the rest of your portfolio, every cent that a company moves up, it's relatively a little bit less attractive than your other options. So I used to be more of an all or nothing guy, a 0 or 1 guy where you're either all in or all out. But as I've progressed and matured as an investor, I'm more and more comfortable taking profits as a name moves up. But I'll also say we don't necessarily sell the entire position right when that expected value or fair value number is breached. If we get to that point, I certainly want to have my initial capital well off the table. But you'll often see these names overshoot, and you can perhaps take profits higher than what you deem fair or expected value. So I try not to be super rigid on that front either. But certainly increase the profit taking and get pretty aggressive with the selling when we reach or exceed expected value. And then, of course, you always need to be monitoring your holdings closely for adverse negative developments that could cause you to sell your entire position overnight. And if it's a single asset explorer where you have a thesis on a drill program and that thesis does not pan out, we'll immediately take our capital off the table and move on. There are many fish in the sea. Or if it's a development stage project where you're banking on a key permit and you think it's likely that the permit's received and for some reason or another it's not forthcoming or it's outright rejected, sell entirely, move on. Plenty of fish in the sea. Or of course, if you see impropriety from the management team, or you see the management team getting distracted and focusing on other opportunities, you've invested in the CEO and then he announces that he's becoming CEO of company XYZ. Another reason to head out quickly. So if we do sell everything at once, it's usually due to an adverse negative development and not because the share price is creeping higher.
It's better to learn how to pick stocks than be given a stock pick. So I encourage you to go to Matt's website, mjgcapital.com. You can download his letter. You can get into his brain, see how he processes and approaches this sector. And as I grew as a resource investor, I found things like that help me even more than just somebody telling me this is a good stock. You want to learn how to think. Matt's been doing this. Matt, 15 years? How long have you been at this?
Yeah, 14, 15 years. I've seen some really ugly times and I've seen some good times as well.
And were you a teenager when you started? You were quite young, weren't you?
I'm loath to speak about this.
Okay.
But yes, I did launch the fund out of my sophomore year dorm room at the Wharton School at the University of Pennsylvania as a 19-year-old. And I certainly would have been better served by waiting 4 or 5 years, getting a little more experience under the belt. But I find that if you're entrepreneurial and young, usually you come in too early, or you don't come in at all. So, I wouldn't rewrite any of my past, but I definitely had some quick lessons that were taught in those early years, particularly during the 2011 through 2015 bear market.
And it was the 10-year lockup that got you through that though, right?
Yep. Survived by the structure. And I want to give Rick Rule some credit for encouraging me to do that. That's the way that he always structured his exploration capital funds. Naturally, it's harder to raise money if you're going to ask for a draconian lockup of that duration. But when the market does not go your way, it's a lifesaver, and it also ensures that you're accepting committed and patient capital. So if it wasn't for that structure, we certainly wouldn't be here today.
Is that still your lockup period? 10 years?
That is, 10 years from first investment. Maybe there'll be some tweaks to that, given where we are in the cycle, but that is the structure of the MJG fund.
It's tough.
But I should also add, I don't necessarily expect the MJG fund to be around 10 years from now. Like, given my experience within those formative years, and how ugly that 2011 to 2015 period got, my goal here is to stick the landing as an investor. And obviously, we're not going to be able to exit at the very top, but if it's a matter of leaving an extra 50 or even 100% on the table in order to send the money back to partners and kind of exit gracefully, that's my goal. But I still think we're a few years off from that being a serious consideration.
Well, congratulations on your success thus far, and thanks for coming on the show, Matt.
That was fun. Thanks for having me, Bill.